Understanding Kangaroo Bonds, a comprehensive guide. Kangaroo bonds represent a unique segment of the global bond market, specifically designed for non-Australian entities seeking entry into the Australian financial ecosystem. Recognized for their distinct characteristics, these bonds allow issuers to diversify their financing options while providing opportunities for local investors. This article delves into the essence of Kangaroo bonds, how they operate, the benefits they offer, and their standing in the broader context of international finance. What is a Kangaroo bond? A Kangaroo bond is defined as a foreign bond that is issued in the Australian market by an entity based outside of Australia. These bonds are denominated in Australian dollars, AUD, and are subject to the stringent securities regulations that govern the Australian financial landscape. The term kangaroo bond derives its name from Australia's iconic national symbol, the kangaroo, and is also colloquially referred to as a Matilda bond. Key characteristics. Currency denomination. Kangaroo bonds are issued in AUD, eliminating the currency fluctuation risks for Australian investors. Regulatory compliance. They must adhere to Australian securities regulations, providing a layer of legal protection for domestic investors. Issuer diversity. These bonds can be issued by a wide range of foreign entities, including corporations, government agencies, and financial institutions. How kangaroo bonds work. Issuers recognize the potential advantages of entering the Australian market, often motivated by favorable interest rates compared to their home markets. The process of issuing a kangaroo bond typically includes the following steps. 1. Determining market conditions. The issuer assesses whether interest rates in Australia are lower than those in their domestic market. 2. Issuance strategy. The bond is structured and issued to raise capital from Australian investors. 3. Use of proceeds. Frequently, the funds raised are converted back into the issuer's domestic currency through financial instruments like cross-currency swaps. Cross-currency swaps are useful for mitigating the risks associated with exchange rates, ensuring that the issuer can meet their payment obligations denominated in Australian dollars while managing their own currency requirements. Benefits of kangaroo bonds. Kangaroo bonds present several advantages, not only for the issuers but also for investors. For issuers. Access to a broader investor base. Issuers can tap into the Australian capital market, widening their potential pool of investors. Lower interest rates. If prevailing rates in Australia are more favorable, it allows issuers to reduce their overall borrowing costs. Diversification of funding sources. By issuing bonds in a foreign market, companies can diversify their funding sources and mitigate risks associated with relying solely on domestic capital. For investors. Currency risk mitigation. Investors purchasing kangaroo bonds are protected from the volatility of foreign currency exchanges since the bonds are denominated in their local currency. Portfolio diversification. Kangaroo bonds offer Australian investors an opportunity to diversify their portfolios with foreign assets, potentially enhancing returns without additional currency risk. Yield enhancement. In many cases, these bonds may provide incremental yield compared to similar domestic bonds, making them attractive investment opportunities. A practical example. An illustrative example of a kangaroo bond can be seen in January 2018, when Emirates NBD, Dubai's largest bank, issued a 450 million Australian dollars, $362.03 million, 10-year bond as part of a larger 1.5 billion Australian dollar program. The bond featured an indicative annual coupon rate of 4.75%. This issuance aimed to diversify the bank's funding sources and support its expansion into new markets, exemplifying the strategic advantage kangaroo bonds can provide to foreign entities. Global context of kangaroo bonds. Kangaroo bonds stand alongside other types of foreign bonds such as samurai bonds, issued in Japan, maple bonds, Canada, matador bonds, Spain, Yankee bonds, United States, and bulldog bonds, UK. These various forms of foreign bonds serve to underline the interconnectedness of global finance, enabling foreign issuers to tap into multiple capital markets based on their strategic financial needs. Conclusion: Kangaroo bonds represent a significant option for non-Australian firms looking for capital and an expansion of their market presence. For Australian investors, these bonds not only facilitate portfolio diversification but also allow access to international corporate debt without the concern of currency risk. As the global market evolves, Kangaroo bonds continue to be a pivotal mechanism for international financing, allowing both issuers and investors to leverage advantages that come from cross-border financing strategies. Understanding this financial instrument is essential for those looking to navigate the complexities of the global bond market successfully.